Hello, welcome to the 21st lecture of the course Forex in 3 steps. We are finally done with the first part of the course and the first step, which was more about an introduction to financial markets and how to have a winning mindset. Now we will start moving to the more advanced and entertaining stuff, which is technical and classical analysis in Forex and in the financial markets and in trading. So what is technical analysis? Technical analysis is basically studying past price movements on the chart to predict the future trend. There are 3 main assumptions of technical analysis. Number 1 is price action describes everything. Number 2, prices move in trends. Number 3, history repeats itself. And based on these 3 fundamentals of technical analysis, traders are able to predict the movement of the markets and forecast what is about to happen next. Before we talk about anything, you need to be very aware and understand the time frames fully. What are time frames? Time frames are the periods in which we view price movement on the chart, such as a minute, an hour, or a day. Each candlestick represents the price movement during that period. So for example, here if we open a 1-minute chart, that means that each candlestick here represents 1 minute. Same thing here, if I open the 5-minute chart on my chart tab, whether it's on TradingView, MetaTrader 5 or anything, that means that each candlestick represents 5 minutes. So for example, if this candle closes at 9 o'clock, then at 9:05 this candle closes, at 9:10 this candle closes. Each one represents the price action and what happened in 5 minutes. So this last candle, for example, tells us everything that has happened between 9:05 and 9:10, and we will explain what a candlestick means and what it's trying to tell us in a moment. Now, there are different types of charts in technical analysis. One of them is the Heikin-Ashi. We also have a normal line chart, which is very popular, and we have the normal Japanese candlestick chart. The difference, a line chart is very self-explanatory. It's just easier to look at and makes the price look smoother and easier to look at, which I see many fundamental analysts who trade based on economic events and political events. They usually have this because they do not care about what a candle is trying to tell them. They only care about just the look and the current price, because otherwise they trade based on news. The Heikin-Ashi is very similar to a candlestick chart, but the only difference is the candles change colors only after a trend has established. So for example, from here to here, where we are trending up, correct? Then as soon as price reverses and begins to go down, this whole area starts being red. Then as soon as we reverse again, the whole uptrend turns green, and then red, green, red, green. So it's very cleaner and very easy to see, especially for those who like to identify the trend easily. So what you can do here, if you open a Heikin-Ashi chart and you want to know the trend, just look at the colors of the candles. So for example, here it's very obvious that the trend is to the upside, but a red candle has formed, which may indicate that, just like this one or just like with this one, it may indicate a slight reversal to the downside. And that's the only difference between a Heikin-Ashi and a candlestick. A candlestick chart, each candlestick is talking to you. It is basically informing you of what happened in this time frame. It doesn't care about the trend, it doesn't care about anything. Yes, you can also identify trends, of course, and we will take that very soon on the candlestick chart. But as you can see, each candle represents what exactly happened during the time interval or the time frame. And of course, the most popular chart type is the candlestick chart. And right now we will learn more about what the candlesticks will tell us. The Japanese candlesticks, they were invented in the 17th century in Japan by the rice trader Munehisa Homa. They are considered one of the easiest tools to use in technical analysis. Each candlestick shows how the price moved during a specific period. So what the candle tells us is it tells us open price, close price, highest price, and lowest price of a specific period. They also reflect market sentiment such as fear, greed, or hesitation through the shape of the candle and the length of the wicks. And for those who do not know, the wicks are these lines at the bottom. Okay, what we call the inner part or the big part, we call it the candle body, and the low and high wicks or thin lines like these are called wicks. So what does a Japanese candle mean and what does it tell us? Let's start with the green candle, which is also a bullish candle, just like we mentioned before. Bullish is for bulls and bearish is for bears. Bears are sellers, bulls are buyers. And if you ever mistaken between them, just remember this: a bull, when it attacks, it swings its horns and its head to the upside, and that's why they're called bulls. The buyers are called bulls. However, a bear, when he attacks, he swings his claws to the downside, and that is why they are called bears, and that is why they are the sellers. This is where bulls and bears come from. So let's start with the bullish candle. The bullish candle and the bearish candle have something very similar. The lowest price is always the end of the wick to the downside, and the highest price is always the highest wick to the upside. Same goes here in a bearish candle. The lowest price has reached during an interval or a certain specific period of time is determined by the lower part of a candle. Same here, the highest price determined in a specific period or time is determined by the highest point of a wick. Same here and same here. The difference only comes in the close price and the open price. A green candle or a bullish candle opens its price from the low of the body. So as soon as you see the start of the body, this means that the edge of this body is the open price and the close price is vice versa. The top of the candle body is the close price. However, for a bearish candle, it is the opposite, and I will explain in a second why. So the close price on a bearish candle is the opposite of a bullish candle, and on a bearish candle the close price is determined by the lower part of the body, and the open price is determined by the higher part of the candle body. And why is that? Because a candle turns green when the open price is lower than the close price, or in other words, a candle turns green when the close price closes higher than the open price. That is how price moves up, right? What does this tell us? It means that the price has started here and it closed here, correct? And the lowest part it has reached is this, and the highest price it has reached is this. That is what a candlestick tells us, and that is why a green candlestick is determined by the open price to the downside of the candle body, and the close price is determined on the upside of the body. And for a bearish candle, the bearish candle is red because it opened at a price and its price went down on this asset or this financial market, which means this candle has turned red and the closing price is lower than the open price, and that is why it is red. If you want to make sure you have understood what I have just explained, please take this task and tell me what this is and what this is, what the edge of the body means, and what the lower wick means. And do the same for the bearish candle and tell me if you have gotten it right in the comment section. So what's the function of technical analysis? Firstly, identifying the trend. So is the trend upward, downward, sideways? What is the market sentiment? How is the market moving? This is very important. Number two is finding an entry and buy and sell zones. Number three is analyzing price behavior and the sentiment behind the movement. Why is the market acting this way and why is it moving this way? What is it trying to reach and how will it react? Number four is forecasting future moves based on history. And like we said, a big fundamental in technical analysis is that price action likes to repeat itself. So forecasting future moves, you can do that based on history and based on previous price action. And the last thing is managing risk by setting stop loss levels and targets. There are a few technical indicators that we will talk about throughout this course. What are technical indicators? Technical indicators are tools based on mathematical formulas applied to charts to identify trend, strength, and overbought or oversold conditions. All technical indicators are considered lagging indicators because they rely on past data, and this is their main drawback. And that is why throughout this course we will not only study indicators, we will also study normal and raw charting and price action. In the next lectures we will dig deeper and we will talk more about classical analysis, and then after that we will jump on to the advanced analysis and expert trading strategies and techniques that will make you profitable in the financial markets. But first we will cover the classical analysis. So what is classical analysis? Classical analysis relies on price patterns and chart formations. It is most famous for, so the most famous patterns for classical analysis are the head and shoulders pattern, double tops and bottoms, and also triangles. It focuses on identifying reversals and continuation zones, which are support and resistance. Classical analysis has existed for a long time. So stay tuned. The next lectures we will be talking about many strategies and many techniques for classical analysis, and then we will jump into the more modern way of analyzing the charts. So stay tuned and don't miss out, and see you in the next lecture.